Good morning, ladies and gentlemen. It is Wednesday again, and it's time for another Investing Systems Trading Service live show. And today we're going to talk about the market. We're going to talk about a bunch of stocks, look at some charts, the usual stuff. So let's go ahead and get started here. Um, Let me pull up a chart of the S&P. We might as well take a look at where we are as far as the overall market goes to start off with. Oh, and I want to remind everybody that today is Fed Day. So today is the day that the Fed is going to come out and announce that they're not raising interest rates again, and then of course a lot's going to depend on the language that they use. Man, I mean, I can't remember a time, Jeffrey. Good morning, Jeffrey, by the way. I can't
Hey,
remember.
Bill.
Hey, I can't remember a recent time where the market seemed so confused on what the Fed was going to do, right? Because I mean, it was like towards the end of last year, the economy was great, and they were on a path to keep raising interest rates and all this, and then all of a sudden, they did a 180, and so now they're basically the market is pricing in like no more rate cuts this year, and it's even thinking that there are rate hikes, I should say, and it's even thinking there may be a rate cut or whatever, which means that basically the global economy is not all that cracked up what it's cracked up to be, and so it's going to be interesting. But the thing about Fed days is they often can mark turning points in the overall market. And so I have a chart of just a plain old chart of the S&P up here. Yesterday was sort of a weird little kind of reversal day, right? We broke out of this range that everybody, I mean literally everybody that watches the markets looking at the same chart, right? And everybody's got a big horizontal line up there. And so we poked out of it, and then we had that reversal day yesterday. And today's kind of starting off weak, but as you know, on Fed days anything can happen. So today's going to be kind of a day to sit back and see what happens here. So, what do you think about this little kind of false breakout here?
Well, I agree completely that market's on a fence post, and yeah, today could be a turning point because uh, according to that chart you've got up there, we've got that little spiked high yesterday, which could be the pivot high, and that could be the harbinger of a downturn. So we could see a leg down. Now, the positive in all this is we've got that really nice. Um, Spiked low, pivot low put in, what is that, 10 days ago?
Yep.
And that cemented in some support, right? Once you put a horizontal line right under that all the way across, you can see that kind of lines up with a lot of the previous support in the past, as previous support and previous resistance. So I think that's kind of the Alamo down there. And you can see if you run that across to the left, you can see how that lines up with all the other stuff on the
Yeah,
screen there.
that low is at 2722, which is literally 100 S&P points down from here. So, do you think maybe, kind of pulling back into that range and clanging around for a little bit is reasonable?
Well, sure. I mean, we could, but what I'm just saying is, even if the market does, head lower over the coming days, that's a heavy duty support level to watch, and you can see how that lines up across, uh, going back to the left there on the chart. How every time at that level, the market either had support or faced resistance. So, uh, yeah, and again, the the market can react to the news today. So we'll just see. We'll have to see what the news gives us.
This day that I'm circling back here, back in, it was 10/10/18, October 10th 2018. This is like sort of what kicked off the big sell-off last year, and so I went back and looked at the news just to refresh my memory as to what actually caused the sell-off, like what sort of started it. And amazingly enough, it was interest rates on that day. Interest rates had hit a 7-year high, and so rising rates was kind of spooking the market. And prior to that, let me go back in time. Well, I don't have it circled here, but prior to that, the Fed had actually raised rates on this particular day, which was, let's see. So this is the day that the big sell-off started, and two, four, about 10 days prior to that, the Fed raised rates on that particular day. Interestingly enough, the day that the Fed raised rates for the last time, which was, I believe, September 26th, I think it was. It had a similar sort of bar or candle to yesterday. It was kind of a reversal day, and then the market managed to sort of rally for a few days, and then it all sort of fell apart. But anyway, interest rates have come down considerably since then. And so, I mean, there's a few things hanging out there that, like, the media is talking about. Obviously, the trade deal with China is a big thing, and man, that's been going on for like, 6, 8 months now. I mean, it's just dragging on and on and on, and they keep coming out and saying they're optimistic we're going to have a deal. And then yesterday, there was like a real quick sort of air pocket in the market that news hit the wire that China might be backing off on some of the, things that I guess they'd been discussing or something. And then literally like 5 minutes later, another news item hit the wire saying that Mnuchin and somebody else was flying to China next week. And so that's just one of those sort of like intraday news driven type of things that, that's out there. And so, it's kind of important because it's obviously affecting the market considerably.
Yeah, we had some price shocks in the market yesterday intraday. Uh, that nice down leg that we had was probably due to that China news, I'm thinking. But yeah, we had I think I even Skyped you yesterday about what happened. We had a I think it was about a 10-point kind of spike down in the market yesterday in
Hmm.
the futures market. So yeah, market's kind of on edge. And so, the thing about trading through this market is it's very hard to, you know, second guess what the market's really going to do. So you just have to kind of stay the course and continue through, trading through the series. Now, obviously, if the market's kind of on hold, like today, I wouldn't be buying like, tons of stock right before they might announce something, right? Give it a bit, and you should always in your swing trading process, you should always ease into things, right? Try to layer in as gracefully as possible into the market. But I wouldn't get too hung up on exactly what the market's supposed to do next, because the market always does what the market wants to do, and it can turn on a dime. And trying to figure it out is a losing battle.
Oh yeah, there's been plenty of times along the way here since the beginning of the year. I mean, here we are, like getting towards the end of March, and the market's been going straight up all year with a couple little dips, but there's a couple of spots along here where, if you overthought it or looked at the chart too much, like I do, you would think that a couple of these spots that was it, that the run was over and we were going to roll back over. And lo and behold, the market's had, a couple little dips and then just sort of continued along its way. But you're absolutely right. I mean, working through the process is sort of the key, right? Kind of using a mechanical type of strategy.
Yeah, and as we always say, if you just keep your position sizes proportional and relative to your level, and you don't go heavy on any, single positions or try to bet big on any single types of trades, then you'll be okay. You'll be able to weather the storm. We get these little false rallies, or what are they calling it? A sucker rally that will, pull you into some trades, and then the market turns and you get some stop outs. So that's just part of the game, part of the process. And here's one thing to um, keep in mind when we have a market like this is, let's say that we got a sucker rally, right? I mean, we've got lots of pending stocks that have been triggering, right?
Hmm.
So let's say you've been taking those trades and then you suffer like a little string of stop outs. First of all, again, with the proper position sizes, no one stop out or even a small group of stop outs should cause you too much dismay, right? If you're using the proper position sizing. But the important thing to remember is this: if we get a sucker rally that pulls you in and you get some stop outs, just realize that um, that's we're just in a temporary phase. So you don't want to freak out. You don't want to get dismayed. You don't want to quit the series because, let's say the market takes a leg down and we head lower to that pivot area that I was talking about. We could see the market bounce big time, and then if you're layering into some stocks down there, you're going to see movement to the upside. So the most important thing is just keep the process and the series going. And if we do see blood in the streets, as we've talked about before, just back off from your buys for a little bit. There's nothing wrong with giving it a break, with new entries for like a week.
Sure, sure. And I expect, if we encounter like one of these big sell downs like we had towards the end of last year, probably won't see anything triggering, right? Because nothing will be closing above the entry. And so I pulled up a chart
Right.
of the IWM here because it's got a little bit. Over the years, I've always thought that the Russell, obviously, it's 2,000 stocks, it's smaller stocks, and so it's kind of a really good gauge of risk appetite, I suppose you could say, when there's, animal spirits and the market's like going bananas to the upside and that. The Russell actually sort of tends to lead because it's the more speculative stocks and it shows that, it's like sort of a risk on environment. And so right here, the Russell's kind of interesting because it sort of rallied up to that same zone there, right? And it kind of had like the reversal, geez, back this is like February 25th where it tried to poke out, above these highs, and look how far the Russell is away from the new highs. So, it's entirely possible that the Russell is like kind of flashing a little bit of a caution sign here. So it'll be interesting to see what happens after the Fed meetings, over and that type of thing. So I expect today, typically, it's kind of dull. Maybe the first half hour of trading or something. First hour, you get a little bit of action, and then things sort of just drift into the Fed meeting. And then, of course, there's the announcement, and then what's mostly important is the language and all that. So today's just kind of one of those days where, until the dust settles at the end of the day, we won't really know what's happening. But
Exactly. What time is that news supposed to hit, by the
it's
way? Do you know?
2 o'clock Eastern time
Yeah.
is when the actual announcement is. So, hey, speaking of, I'm gonna pull up this Lazy Boy LZB. This is one that is kind of an interesting. This is on the pending list, right? And this is one I mentioned. I think I mentioned it last week or at some point that I thought it looked really good, but I wanted to pull this up as an example of kind of waiting for a close over the trigger, right? Because this one never actually closed over the trigger price. It came close, but just by sort of a fluke, it kind of poked at the trigger, started rolling back over, and so never actually became an open trade. As much as I sort of liked this chart here, this is kind of an example of what you're talking about. Sort of a little sucker rally. I mean,
Exactly.
everything
Yeah.
about this sort of was set up, but a lot of times, after you see a big, huge rally, the very first little pullback and then reversal doesn't necessarily just carry, right? Like you don't always just turn right around. As orderly as this chart was and this perfect little pivot low and trend line break, it just didn't get the follow through. And so it didn't trigger, like I said.
Yeah, well, therein lies the rub in that we have multiple types of follow through that you're going to see. You're going to see different flavors. We might have talked about this in one of our first shows, the types of follow through that we get, and one of them is that uh, it doesn't turn on a dime, just like this example here. We get like a little bounce, and then we're going to need, in other words, we're going to need a second attempt. So um, this can still be on the pending list for a while, and we may see a trigger down the road further down. But this is a good example of, again, like you said, there was no close above the trigger, so no harm, no foul, but it was really close. Now we do have some stocks that are triggering just like this, and we'll have to see, what the follow through is.
Yeah, absolutely. So, speaking of the pending list, I was going through there, and this HBI, it kind of has a little bit of a similar pattern, and kind of looks interesting to me. It's had a big run up, and then I'm gonna guess that this big long range day was due to earnings back in February, and so it's sort of building one of those patterns that's a little bit similar to the last one, but as you can see, it still hasn't closed over the trigger, and so this is it's poked at it yesterday. You can see today that it's kind of drifting down with the overall market. So anyway, this is just looking through the pending trades. I always like to just kind of one thing I like to do, and maybe I'm not set up for this right now, but at some point I will go over the how to export the ticker symbols, which you can just click the CSV on the page and export them, and then just paste them right into FinViz. And so that's kind of a neat little thing because it allows you to basically eyeball all the stocks on, the pending list or the open list or whatever. Just be able to eyeball them with a couple of clicks, and then I usually go through there, and the ones that sort of appeal to me, I dig a little closer into. So this is just one that I thought looked kind of interesting.
Yeah, the important thing to get out of what we're talking about is this. Um, we're gonna have periods of drawdown in the market, right? We're gonna have sluggish market conditions or a market that sells off, and you will see the degree and the frequency of the follow-throughs on your trades will fall off a little bit during these sluggish market periods, right? That is to be expected. That's normal, and just consider it like a little rough patch that you got to push through. But again, you can't second guess the market because 2 weeks from now we could be on the show here talking about all-time new highs and everything, and right. And so if you
Sure.
throw in at any point if you throw in the towel, you stop the process. And any good kind of system has built in the characteristics of being able to self-correct, right? So now the most important thing to get out of drawdowns, though, is this. Drawdowns will occur in the market. So let's say that you've been following the system for the past few months. You can go back and look in the closed trades and just see the phenomenal follow through that we've gotten, right? On tons
Hmm.
of trades, big gains. And so if you've been following the system for a few months and trading it, then a little bit of drawdown is more of an annoyance, right? There's nothing to really get worried about because you're just kind of maybe you're drawing down into house money, right? That you've
Sure.
already put.
It's
Right. But if you're just starting out now, keep in mind that the drawdown, and this is a great little training we should do sometime. The drawdown um, can be occurring up front, right? You're just starting and you're already getting drawdown, right? And you're like, wow, what's happening here, right? That's one of the challenges to starting any system. You could incur a little drawdown period right as you start. Now, the problem there is if you catch a little bit of drawdown and then you go, oh, this don't work, and you quit, you stop the series that can it will self-correct and go on to be profitable when the market picks up again. So that's a really important concept to get. If you are, it could be your dumb luck, right? When you start, you're going to catch a little bit of drawdown, and you just have to weather through that. Or like I said, you can hold back. If the market seems like it's going to, selling off like next week, don't take any new purchases for a week. Give it a break. There's no swing trading is a process that occurs over, the series and over the longer term. So think longevity. You want to be around here in a few months, continuing to be taking the trades because um, everything works over the series.
Yeah, I mean, speaking of drawdown, you can look at, I pulled up a longer term S&P chart. I mean, look at all the spots on this chart where, if you decided to, I mean, the market is basically back where it was like 15 months ago, right? I mean, back over here around the end of 2017 is literally the first time that we were at the level that we're at now. And so there's all sorts of spots on this chart where, if you decided to, start your swing trading career, you could have suffered drawdown along the way.
Well, exactly. And so, again, it's really tough to second guess what the market's going to do. And the market goes through different types of phases. Okay, so I'll go over like a couple of the phases that we see. One is called they call it the markup phase, right? It's an old-fashioned term. Basically, it's where the market is under broad accumulation. In other words, there's a lot of programmatic buying going on out there. There's a lot of institutional buying going on with stocks on a regular basis, day after day after day. And that's what propels the market higher. A great way to think about it is think about it in a general sense of like, plugging one of those old-fashioned tubs, right? You put the plug in, you let the water drip, turn the faucet up a little bit, and the water is just going to gradually accumulate, right? And that's what happens in an accumulation market. Now, guess what happens? If the market starts to sell off, right, and head lower, or it can be sluggish, what happens is that the accumulation engines, the buying engines, just kind of stop or slow down, right? They just take a little break.
Hmm.
And when the dust settles, they go right back on again. So that's why we can see a market that, it moves higher and then it takes a little rest break and then it picks up again, takes a little rest break. Those are those phases of heavy accumulation and then no accumulation, heavy. So that's the accumulation phase. Then there's the, blood in the streets, um,
The
watershed
markdown.
sell-off, right? Like we see in the middle of this chart, watershed sell-off, where there is no accumulation. It's just sell, sell, sell. And so two different types of markets, and we're not in like the sell, sell, sell market right now.
Hmm.
We're still in the accumulation phase of the market at this point.
Yeah, since the beginning of the year. And so, yeah, at some point, they usually start taking profits. The tricky thing about where we are right now is that every little dip seems to be getting bought since the beginning of the year. And so there's a lot of these guys I see on CNBC out there that they really expect new all-time highs, sometime soon. And so it's going to be interesting how this plays out. We're in like one of these sort of spots right here where I don't think anybody can really tell what happens. So sticking to the plan is a pretty good idea. The thing of it is we haven't really seen signs of like significant distribution or markdown like you were talking about. And I mean, yeah, we've had, a few little, days down and, yesterday kind of like you said, the little reversal, but that doesn't necessarily mean that, we're going to get a huge sell off here. And so we haven't seen, I guess I go back to like the old William O'Neill How to Invest in Stocks book, and he called it like, institutional distribution, where you can just clearly tell you start to get really big long range days on heavy volume down, and that usually sort of kicks off like a bigger sort of sell off. I mean, we might just be looking at like a little dip here for, a couple of days, and then it turns right back around. So it's best not to really try and second guess what's going on.
Yeah, anytime you can see a market, and this is true with an individual stock or the general market. An old-fashioned rule that I use is if you get a day that's three times the range, the average range, and three times the average volume in one day, and it's to the downside, that's usually institutional. That's the first salvo where they're dumping a lot, and that could be a harbinger for the market to move lower. So, uh, you know, big long range day and big high volume, and we could, that could be the beginning of a little down leg. Uh, One important thing to get about the swing trading process, and this is why it's so important to let some of your winners run. If you're one of these super scalpers that's like just trying to pull, tiny profits off your swing trades, you get hit when we might have a higher percentage of stop outs, right? Because uh, let's say that you were in a bunch of positions and then the market takes a big move to the downside, and then you get stopped out on all of those, and you're only taking small profits, then you just have to individually make all of those up. Whereas if you go back and look at the closed trades, you can see, you could have two or three or four, or five stop outs on trades, right? And then all you need is one of them, one decent winner to make it all up again, right?
Hmm.
So just keep those statistical things in mind that, yeah, if you hit a couple stop outs, I've been getting stopped out on a few trades here and there. And again, it's no biggie because if you go back and look, we're running on heavy duty house money. But again, if you're just starting off like this week or last week, then it can be kind of tough going for you.
Yeah, the reason I pulled this chart up is, well, this is actually kind of just a good overall example of how the system is designed to trail the stop up. And I believe that this is one I was talking about last week. On this Wednesday, we were looking at this and how nice this looked, and then by the end of the day, man, it had this huge long range day, and I believe it actually poked the target that day. Spent a few days like sort of poking at the target and pulled back. Interestingly enough, this is one where I believe we were talking about the parabolic stop, which had kicked in right the I guess the night before we did the show last week, and so this is kind of an interesting study on just basically how the overall system's designed to work. Sort of caught the trigger back here, 2220, and then wasn't really a whole lot going on here. It was sort of drifting higher, and a lot of really sort of wide, I guess, long range days they look like, just sort of overlapping. And then, but it did have an upward bias there, and you can see how the stop sort of trailed along. By the time that you got over to here, even though the price hadn't really gone, too far up, the trailing stop basically had you at break even after a week or so. So that's kind of interesting. And so when you talk about these sell-offs in the overall market, typically the system is going to have your trade. If a stock's been open for a week or two, that trailing stop's going to have moved up and away from the initial stop, right? So the worst thing that can happen is when you get into one and it immediately turns around and goes down, hits the initial stop. Typically, after some time, the trailing stop's going to have kicked in and sort of minimize the damage on any sell-off.
Exactly right. Yeah. So you get like th three basic flavors of follow through, which is one, the trade's going to not work out right away, and that could be even be an individual news event on a particular stock, right? You get in, and then again, your dumb luck or our dumb luck that there's some negative news that comes out and it comes right down and hits your stop, right? Or the setup area just fizzles, right? Technically, it just doesn't follow through. So you come down and you get a full stop out. The other flavor is where you get into the trades and the trades actually, the setup germinates and it gets off the launching pad and takes off and you get a runner under your belt, right? And as you said, you know, as the system trailing stop starts to move, that system trailing stop can get closer and closer to your entry point, so you effectively are, at break even. So one of the flavors of follow through that we get is that you can get some initial gains, and then if the market does take a big downturn, you just get knocked out, break even. I'm in several stocks right now that if they don't work out, I'm not going to lose money on them because it's going to come down and just hit the uh, the system trailing stop, which is above my entry point. See, so the three flavors, big winner, your full stop out, or you can be at some point around break even or with small gains.
This JKS is kind of an interesting. I guess it's an interesting look. It's one that recently got open. Actually, let's see what day it crossed the trigger price last Thursday, and so based on waiting for an entry above the trigger, you got in somewhere around here. But this is kind of an example of when they actually work. This is what you want to see. A stock that's in sort of nice primary uptrend. It has a pullback, and then this is really sharp pullback and reversal. But there you go. I mean, this thing basically has you've got what, one, two, three, four, six higher lows in a row here, and so this is sort of, I've seen plenty of these since we started this, where basically you get a little pullback in the stock, it kind of bases out a little bit, turns around, and just immediately snaps back like this. So this is kind of interesting. The most interesting thing about this is that the initial stop as of last night hadn't moved yet, and so I'm going to guess that the system is likely, after the close today, is likely going to move that stop up. When you think?
Yeah, I think you can expect a stop move on that one today, just because we're continuing to get the forward motion.
Yeah, let's see. What other examples do I have here? I have this MITK. This is another one that sort of caught my eye. This thing is sort of this is a volatile stock. I mean, the increments over here are only a dime, but man, this thing really tends to sort of swing or whatever. But this is similar to the last one in that it had the little pullback, and once it started going up, it really sort of took off, and we've had the first initial stop move here. And so there you go. It's like right up to break even, which is perfect. And so that's kind of what you're looking for is, correct me if I'm wrong, the real sort of trick is, getting into one that gets that stop up the break even. And so essentially, no matter what happens here, you don't really have a whole lot of risk in this trade.
Yeah, and you have the ability to, if you want to go to break even, you're going to look for three higher lows that are above your entry, right? So 3 days where the low is above your entry point, that is your little uh, self trigger to get to break even if you want to protect the position. You can see in that example, you could have gone to break even on your own a few days back, right? Because you had 3 days uh, where the low was higher than that trigger area where you would have taken an area and there's an entry in that area somewhere.
Let me ask you this. Suppose, like we get the close over the trigger here, and so the trigger was 11, and so the next day, you're talking about like 11:10 or 11:12, assuming that you got in like right around the open. And so if you were going to use that where you had the 3 days where the low was above the trigger, would you put the stop down at the trigger, give a little extra breathing room?
Well, the whole point would be to just protect your position, no loss. So it would, wherever your entry was, you'd stick it right at your entry, and that's an aggressive maneuver. It it's got a good follow through. In other words, that tends, once you get three lows that are higher than your entry, that tends to hold. And you can see in that example, it would have been okay. And again, it depends on where you took the entry. But you can see how the system stop eventually ratcheted up and just gets you to break even. So again, over this series, lots and lots of trades, everything smooths out, everything averages out, and you're going to have lots of trades that go on to be winners. You're going to have lots of trades that get you to break even. You'll have some trades that the trailing stop is above where you bought, so you end up with a small gain, right? And then there's going to be many times where the stop is just a little bit under where your entry was, so maybe you take a small loss. So it all averages out over the big series.
Interesting. Here's one, this MTCH that is basically just, just now triggering within the past couple of days, and I thought this was kind of an interesting little case here. Hasn't, it's sort of moved away from the trigger a little bit, but really nice run up. This is probably earnings, if I had to guess, this crazy, spike high reversal day, but nice little orderly pullback. If I put this on a candlestick, you could probably draw a trend line similar to what I have here. And then sort of a nice little turnaround, and so this has got a fairly decent look to it. It looks like one of those patterns where run up, pull back, and reversal. And so that's kind of the overall strategy that we're using here, right? Is that we're looking for stocks that are in near term uptrends that have a pullback. And I'm sure people have noticed on the pending list that a lot of times when a stock first appears on the pending list, the entry price, or the trigger price, I should say, is can sometimes be considerably higher than the current price. But as time goes on, the price and the trigger sort of converge, right?
Yeah, and that's designed that way on purpose because, the worst thing in the world is, you wake up and you get a big flashing signal that says buy, 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 and you're like looking at a stock for the first time and you're going, oh, I got to buy this stock here. So think of the trigger line. You're going to see once a stock gets on the pending list and becomes a potential candidate, it's already going to have a trigger line, and that trigger line is going to be, potentially up above where this the stock is currently trading. So don't look at the trigger line and go like, well, why in God's name would I want to buy way up there, right? No, think of it as a barrier to action, right? That's what I actually prefer to call it, a trade barrier. Trigger line sounds sexier, but think of it as a trade barrier. So as long as the price is below wherever you see the barrier at that point in time, if its price is below there, it's just not actionable at that point. And as you said, as the stock smooths out or continues to pull back, you're going to see that trigger line or the trade price barrier start to converge, and eventually they merge and converge, and we want to see a close past that trigger. So think of the trade barrier as a way to keep you out of the trade as well. See, it's not just about like when do I get in, when do I get in, when do I get in. Half the battle is knowing when to stay out. Any kind of trading, whether it's day trading or swing trading, it's all about the timing and the tolerances. So think of that, the trigger line or the trade barrier. Think of that as that is my my barrier to taking any action until I see it close above that line. So don't fret about if you see that trigger line higher.
Here's an example that I wanted to talk about this for a minute, and I was actually going to do a blog post on this at some point, and this is actually a great example. Look back here. Here was the trigger line, right, at 96.60, and you can see how the price just gapped right over the trigger line and had, kind of a crazy day or whatever. But the following day, even though it had like sort of the reversal day, the following day it had closed over the trigger line, and so look at where it opened. I put a horizontal line on this ICPT right where it opened the following day. And typically, I mean, we talk about if a stock gaps too far over the trigger, you may or may not want to take it or look at it. But this is an actual case where you had a fairly significant gap over the trigger line, and it went on to do pretty well. Now I didn't. I think I'm probably missing a stop somewhere around break even down here on this pullback, but you can look and see how it actually triggered, pulled back a little bit, and then just marched higher right up towards the target there. And even as we speak, this is still an open trade. And yesterday it kind of poked at the second parabolic stop, but you can see it did actually hit the target here. So this is kind of interesting. You want to talk for a minute about what to do when you get a gap over the trigger line?
Well, sure. The thing about the trigger line or the trade barrier is, if you can get an entry near that, that's great. But don't fret too much about like the trying to get entries to the penny, because again, it all smooths out over the big series of lots of trades. So, if you did get a big gap up, there's two ways to approach it. One is that you just pass on the trade, right? If it's a big gap and go where, you're already several percent above the trade barrier and the stock just keeps running higher, well, guess what? You missed it. No big deal. Um, the trades are like buses, another one always comes along, right?
Hmm.
So you just wait for the next one. But the other thing you can do is you can go ahead and stick a limit order somewhere down reasonably, above the trigger line, and it, just good till canceled even, and just keep an eye on it and let that potentially fill. And then the third option, if you want to get more sophisticated, is you could split your position. You could go ahead and just take half the position at the open the next day because you're above the trigger line, right? You're trading above that trigger line, and then stick uh, a buy order lower on the second half. So what's going to happen is you're in that stock, right? And if it's a gap and go and never looks back, well, at least you're in a half the position. If the stock does pull back towards the trigger line, you're going to get filled on the other half, and then you got like an average share price. That's kind of the way I approach kind of gaps like that. But again, quite honestly, you don't have to take every single entry. It's the trades are like buses. Another one always is going to come along. Just park your money where you can. And a great thing to keep in mind is, yeah, you don't want to sweat the minutia too much. You can see how that one wiggled all around up and down before taking off. There's actually a bunch of examples like this. When I was talking about the flavors of follow through, we get several flavors of follow through. One is a nice, smooth, quick, move in our favor, right? The trade just closes above, you take the entry and it's off. It just never looks back, right? And it looks like a perfect textbook case, 2 weeks later. The other flavor is we get tug of war and a little battle around our entry area, right? Up and down, up and down, up and down, and then it can finally take off. So it's all about letting the position, germinate and build support and take off. A great thing to do is to, if you can take these trades, you maybe set a target on half the position, the system target, and then your full stop, and then just don't even worry about the wiggles. Just as long as you have your orders in and they're good till canceled, you don't need to be looking at the wiggles every day on the charts.
Sure, that'll drive you crazy, right? Because the idea of this, I think I call it, characterize it as low frequency trading. This is meant to be kind of a stress-free mechanical way where you're using sort of a systematic methodology. And yeah, the most important thing is that you want to approach it without being stressed out about getting stopped out. Or I've had people in the past say, "Oh, I missed it." People worry about missing out on profits, right? And which is definitely, like, not the mindset to have when you're in the market, because the market's always going to do what it does. And I mean, missing out on profits is like the last thing anybody should be worried about. But one of the ways, like you mentioned, to sort of smooth things out, and that has a good psychological effect, is, like you say, splitting the position, right? And so something like this, if you were in this, you saw this parabolic stop kick in, you could think, okay, well, maybe what I'll do is I'll set a sell order on half of my position at this parabolic stop. And then lo and behold, you see it, a couple days later, it's up at the target. And so taking profits at the target, or even, and this is what I was alluding to, is suppose that, you looked at this and you missed selling half at the target here. Well, that parabolic stop had kicked in that very same day, and so all you would have had to do is is just raise your parabolic stop on half the position up to there, and then yesterday, you'd be out half this position and actually sitting pretty now. So, now you got half a position. This is your current stop loss down here at 105.25. And so even if it comes down there, you actually had a successful trade.
I tend to like to take at least half off on uh, the initial system target when we get there, right? And let the rest work. Now, there's scenarios where you might want to pull everything off. Let's say the market's made a big run, and maybe we're talking about the market, and we can see how the market's like run right up to a resistance level, right? This is just a hypothetical scenario, and you're in a bunch of trades, and they're working in your favor, and a bunch of them are hitting the targets, and we're going into a 3-day weekend, right?
Hmm.
Perfect scenario. You could say, hey, you know what? I'm hitting these targets, and the market could be hitting resistance, and we're going into a 3-day weekend, and I want to relax. Take those trades off the table at the targets. So you can manage discretionarily like that a little bit, but the most important thing again is you got to keep the series alive, keep going, because you know without without doing anything, the market will hand you winners on a silver platter, right? So in 2 weeks, in retrospect, you're looking back and going, wow, I'm glad I stayed in, some of these trades, and they've gone on to give big percentage returns, and they help clean stuff up. Think of a big runner, and what's our biggest gainer that we know of on the
Right now, it's just I,
no,
I.
well, I meant in like the closed trades. What
Oh,
was
in
our
the closed trades.
Yeah,
Oh,
what was
okay.
our
I was.
biggest one? Go look for that real quick so I can just use that as an example. But if you catch a big winner, think of it not as always as, hey, I'm making tons of money here, but a big winner can, I like to think of it as, mop up on aisle seven. They, a runner or a big winner can help clean up lots of little stop outs, right? Help pay some of your commissions, right? And
Sure.
so the market's going to deliver those to you as long as you continue the series and you let some of these suckers run,
Yeah,
right?
the Twilio TWLO, which was actually when we sort of started doing this show, was one that we basically looked at every week because it was like sort of a perfect case study of what we were doing here. And so that one, amazingly enough, and you can see what happened here. We closed this ahead of earnings, right? And then of course, it took a winger right after earnings. It's actually continued to rise, but this thing, the minimum gain from the entry, from the trigger over here to the closed ahead of earnings, this was 33%. 33% gain on Twilio here. So that was pretty amazing.
Nice. Yeah, and so there's an example of from the trigger to now, that's like a 50% gain.
Hmm.
Yeah, the entry was down at what, 86 something?
Yep. Way down here.
86.50-ish. Yeah, we're talking that's a 50% gain right there if you had held um, through earnings. Now, we don't recommend that you hold through earnings, but again, let's say you'd taken your entry and you pulled a half off at the target, then it would have been relatively low risk to hold the remainder, right? It would have been almost no lose to hold the remainder at break even, right? And so it's possible to hang on to some of these trades. But this is where, one or two of these, once in a while, these nice runners, they help just clean everything up. They take care of all your stop outs. They neutralize all your stop outs. They pay all your commissions. Boom.
Sure. This CDXS, this was another one that ran around 30% from the trigger. This one's interesting because it triggered and then came really dangerously close to the initial stop. Right? I mean, it came really close to the stop right after that. And so, but then it turned around and it took off, and of course, this is another one that got closed ahead of earnings, and which is, a good example of why we close them ahead of earnings because it sort of had leveled off here right ahead of earnings, and then kind of had a negative, sort of a negative reaction. Amazingly enough, it dropped all the way back down to like where the initial target was. So, the one that we have open right now, IIPR, is actually the biggest gainer on the open trades list, and just hit the target yesterday. This is kind of a great example of how when you get these dips and these strong stocks like this, and then you get that sort of pivot low reversal day, they can just turn around and just run up here. I mean, I like to look at these charts and I see prior run ups that happened really quickly, and those type of stocks are sort of interesting because whenever you see a stock that can just have a massive run up in like 3 or 4 days, those often tend to repeat, right? And so this is a pretty good example of one that did exactly that.
Yeah, that's a nice example. That's a good example of a stock that pretty much took off quickly in your favor and never looked back, right? No worries about drawdowns or anything. The day of the trigger, basically, the stock just started moving higher. So, yeah, you should. We may see a parabolic stop kick in
I was
on
just
this one.
thinking that. I was just thinking like a parabolic stop under somewhere around yesterday's low probably kick in. But yeah, I mean that's a pretty quick run to the target, and so again, this is a good example of you get the close above the trigger, even though it had a pretty good run, and so the following day, you're looking to enter somewhere as long as the open is around the trigger, and you can see with something like this, I mean it really, you know since this is kind of an expensive stock, even though it opened a couple of bucks above the trigger, let's see, what was the open that day? 77.02. So, I mean, you're talking $75 stock, 75 and a half trigger, opens at 77. Not a huge big deal, right?
No, not a big deal. And you can see that on this one, you had a to the target there. That was a 16% move to the target in just within a week, right? So not too shabby. Um, the again, the targets are high frequency hits. Okay, so you can shoot for the target, right? Either on your full position or I would definitely, if you get a stock that runs smoothly like this into the target over, in a short period of time, I would definitely take half off there at the very least.
Yeah, and interestingly enough, the little fudge factor you had here between the close over the trigger day and the following day where it opened, a buck and a half higher, you actually had the compensation, I guess you could call it, compensated for it by like opening way over the trigger here, right? So that's kind of interesting. It's just sort of an interesting little case here. And let's see, there was another one that I wanted to look at, and oh, I know what it was. It was AZUL, which is kind of a weird one because it's a foreign stock, right? And so it tends to be real gappy, and so that's something to keep in mind. I mean, obviously, the user is free to sort of look at the charts and pick and choose. I'm not a huge fan of gappy stock, or foreign stocks tend to be gappy, right? And so this is a South American company, and you can see how in this case gapped over the trigger, and so based on our just basic strategy here, your entry would have been somewhere around here. But this is another case where, getting in over even though you had the gap over the trigger and it was higher, still didn't make a huge big difference, right? Didn't make a big difference. And even though the trailing stop now is over the trigger, it's still a little bit below what would have been your entry here. But good looking stock here. I mean, this is a nice uptrend. And so that's going to happen. I mean, that's just sort of the nature of stocks. They tend to gap around, and so you have to sort of just work with that.
Yeah, and also keep in mind, make sure you read the documentation about position sizing. We're going to have our position sizing calculators here pretty soon to work with. But if you follow the formulas, the risk uh, per trade formulas in your entries, uh, you know, you would you would not necessarily incur any extra risk by taking that trade. Why? Because your entry is going to be higher and your stop is still going to be, your initial stop's still going to be in the same place. The formula that you would follow to fix your risk would just have you buy less shares, right? So the risk would be identical even though it gapped higher.
Gotcha. And in a
Yeah.
lot of cases, I pulled up this ARRY. This is the last one I want to look at, but this is kind of an interesting one because when you look at the chart and the entry here, this is kind of a beauty too. I've noticed that a lot of times these stocks in these sort of uptrends, they have these little pullbacks, and sometimes they're just a few days, and sometimes they're couple of weeks. But here's another case where you had sort of a sharp sell off, perfect pivot low, and then it recouped. But what's most interesting about this is kind of you sort of had like a little flat top breakout on this, right? And what I think is interesting about this is where that target is. Look at that. You have the target sort of, I mean, it looks like it's pretty far away until you zoom out on the chart. And quite frankly, it's this is a pretty nice little breakout. You've already had your trailing stop move, and you're getting some follow through. And so this is another one that sort of I'm gonna draw just another little kind of flat top breakout that looks like, even though the market's sort of struggling here, this thing looks sort of primed to continue to move towards that target.
Yeah, that looks like that's a very constructive chart. And again, notice um, the down move there, that previous pivot low, that knocked out all the weak hands, and then the market, or in that particular stock, the price got above all that resistance, which is now, the yin and yang effect. It's now, you can consider that support. So yeah, that one's a very constructive looking chart, and the target looks very reasonable on that one. If you take the low of that pivot low that you got circled
Hmm.
to the where the stock is right now, that distance, and you just extrapolate that higher, it would easily take out the target.
Absolutely, and like you say, this is longer term. This is a pretty constructive looking chart here. So, yeah, so we've looked at some pretty decent open trades that we've had. We looked at a couple that have just triggered, and looked at a couple that have gapped over. So some pretty good examples, and like you say, the final touches are being put on the position size stuff. So I'm pretty excited about that, and that's something that we can really dig into next week. The whole position sizing thing, and so that's kind of like the next step. And we've also got some other really cool stuff coming. Had some good ideas, and so yeah, this everything's still evolving a little bit, and I know that the updates have been a little bit later in the evening than we're going to update. And so, a few hours after the close, sometimes a little bit later, because we're kind of going over everything with the fine tooth comb, making sure that everything's just right. And so we want to make sure that you guys know that there's still some new things coming here, and I think that we're going to see those shape up pretty quickly here. So, with that said, I want to thank you for coming on the show, Jeffrey, and we will see you back here next week.
All right, Bill, see you next week.
All right, thanks.